Let's go to that interest rate decision today. In Windhoek, the Bank of Namibia Monetary Policy Committee announced the decision to cut the key interest rate by 25 basis points, bringing the repo rate down to 6.5%. And that was a move to bolster the domestic economy. The Governor, Johannes Dewazab, speaking at the press briefing following the MPC meeting, said the cut reflects signs of weakening economic activity while inflation remains modest and well contained. Now let's take some excerpts from his presentation.
Good morning and welcome to the MPC announcement. The Monetary Policy Committee of the Bank of Namibia decided to reduce the repo rate by 25 basis points to 6.5%. This was done to continue supporting the domestic economy while safeguarding the peg between the Namibia dollar and the South African rand. This was done following a review of international, regional, and domestic economic developments. Our decision to reduce the repo rate is entirely data-driven. Let us consider the factors in the domestic economy that has informed this decision. Domestic economic activity has weakened, inflation remains subdued, while growth in private sector credit extension has improved further, although it remains relatively weak. The merchandise trade deficit has narrowed further, while the stock of international reserves remains sufficient to maintain the currency peg and meet the country's international financial obligations. Real gross domestic product growth has surprised on the downside, fallen to a post-pandemic low of 1.6% year-on-year in the second quarter of 2025, from 3.3% during the corresponding period in 2024. This poor performance was primarily observed in the manufacturing, fishing, and agriculture sectors. High-frequency indicators further corroborate this trend, suggesting that the pace of expansion in economic activity during the first 8 months of 2025 has slowed compared to the same period in 2024. Looking ahead, real GDP growth for 2025 is projected to decline from 3.7% registered in 2024, with downside risk now more pronounced. Annual inflation remains contained, averaging 3.6% during the first 8 months of 2025, compared to 4.6% during the same period in 2024. This disinflation was primarily reflected in the categories of housing and alcoholic beverages, augmented by deflation in the transport category. Moreover, consumer price inflation has remained unchanged at 3.5% in September 2025 relative to its level in July 2025, although it temporarily dipped to 3.2% in August. Looking ahead, inflation projections for both 25 and 26 have been revised downward by 0.2 percentage point to 3.6% and 4% respectively, compared to the previous forecast. This revision reflects a stronger exchange rate assumption and a downward revision to the oil price outlook. Rest to the forecast remain exchange rate volatility and potential upticks in administered and oil prices. The annual growth in private sector credit extension has continued on a gradual recovery path, rising to a post-pandemic high of 5.8% in August 2025 and remaining above the 5.7% recorded in June 2025. Similarly, the improvement in credit to the private sector was observed in the year-to-date average growth rate, which stood at 4.9% in the first 8 months of 2025 relative to 2% during the same period in 2024. Overall, The improvement in PSC was mainly driven by stronger credit uptake by businesses, while households lagged. Pivoting to the external sector, Namibia's merchandise trade deficit narrowed by 16.1% to 17.9 billion Namibian dollars during the first 8 months of 2025, relative to the corresponding period in the previous year. The improved trade deficit was on account of a faster increase in export earnings, especially from uranium and gold, relative to import payments during the period under review. The stock of international reserves stood at 54.7 billion Namibian dollars at the end of September 2025, a decline from 58.1 billion Namibian dollars recorded at the end of July. The reduction in foreign reserves was mainly ascribed to elevated imports, foreign payments by the government, and a stronger exchange rate. This level of foreign reserves translates to an estimated import cover of 3 to 6 months, remaining adequate to sustain the currency peg between the Namibia dollar and the South African rand and meet the country's international financial obligations.